Silver just dropped to $76 on February 17, 2026, and every headline is calling it a routine dip. But the same metal that more than doubled in 2025 is now in its sixth straight year of supply deficit, with solar panels, EVs, and AI data centers consuming it faster than mines can produce it. So who is actually selling, and why right now? Welcome to the Market Flux. I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now, because what I am about to show you explains why this silver pullback is not what most people think it is. Let's start with exactly what happened today, February 17, 2026. Silver, trading as XAG USD, slid to 75.98 during the Asian trading session this morning. The 20-day exponential moving average has dropped to $83.50. Price is sitting more than $7.50 below that level. That gap tells you sellers have been in control for weeks, not days. The RSI reading sits at 43.67. That is neutral territory, below the midline of 50. Momentum is tilted downward without being technically oversold. U.S. markets were closed Monday for President's Day. Liquidity was thin. That kind of low-volume environment is exactly when large players push prices to levels they want. Meanwhile, January's U.S. headline inflation printed at 2.4% year-on-year, down from 2.7% in December. Core CPI came in at 2.5%, exactly as expected. On paper, that is cooling inflation. But despite softer inflation, the Federal Reserve left rates unchanged at 3.50% to 3.75% at its January meeting. No cut, no signal of a cut, just a wait-and-see stance. The FOMC minutes from that January meeting drop tomorrow, Wednesday, February 18th. That is the event the entire market is watching. That is why silver is sitting at $76 right now. Not because of fundamentals, but because of a Fed meeting transcript. Now here's the mechanism that most retail investors completely miss. And once you understand this, the silver price action will make total sense. Think of silver like a seesaw with two people sitting on opposite ends. On one side sits industrial demand, solar panels, EVs, AI chips, electronics. It never gets off. It just keeps getting heavier every single year. On the other side sits the US dollar and interest rate policy. When rates stay high or go higher, the dollar strengthens and gets heavier. When that happens, the seesaw tilts toward the dollar, and silver gets pushed down in dollar price terms. But here's what makes this seesaw unusual. The industrial demand side keeps adding weight constantly. 185 million ounces of silver consumed by solar alone projected for 2026. And the interest rate side, it is stuck in place. Rates have not moved since December 2025. So what you're watching right now is a pause in the seesaw, not a structural break. Traders are waiting for the FOMC minutes to tell them which direction the Fed is leaning. Until that moment passes, silver is going to stay exactly where they parked it, near $76. Reason number one for this pullback, the Fed's silence is doing the talking. The Federal Reserve has not cut rates since December 2025. PCE inflation is still running at 2.8%. Jerome Powell's term ends in May 2026, and Trump is about to name a replacement. The market has priced in zero rate cuts until the second half of 2026. That removes one of silver's biggest short-term tailwinds, the promise of cheaper money. When rates stay elevated, silver pays nothing, while government bonds pay 4+%. So in the short term, money rotates away from non-yielding metals. This is textbook. This is not permanent. But this is happening right now. Reason number two, institutional selling through the futures market is being misread as bearish conviction. The CFTC's Commitments of Traders report shows hedge funds reduced net long positions in silver futures for 3 consecutive weeks entering this week. The put-call ratio for silver options rose to 1.8, meaning there is significantly more bearish hedging than bullish. But here is what that data actually tells a trained eye. This is not conviction selling. This is position management ahead of a high-impact catalyst, the FOMC minutes. Professional traders are not betting silver is finished. They are reducing exposure while uncertainty is highest so they can re-enter after the event. Reason number three, China's export restrictions on refined silver took effect January 1st, 2026. And the mainstream narrative has barely mentioned this. China tightened silver export licenses at the start of this year. The world's largest producer of refined silver began restricting how much processed silver leaves its borders. And this happened right when global physical demand is at structurally elevated levels. Yet retail investors are staring at a chart going down and drawing the wrong conclusion entirely. Now here is the wake-up moment. Because while most retail investors are looking at a price chart going from $80 to $76 and calling it bearish, the big players are quietly doing something completely different. While you were reading headlines about a silver dip, The Silver Institute published its 2026 forecast, showing the silver market will run its sixth consecutive structural supply deficit this year. Mine production and recycling combined are expected to reach a decade-high 1.05 billion ounces in 2026, a 1.5% increase. But physical investment demand from bars and coins alone is forecast to rise 20% to 227 million ounces. Western investors are finally starting to accumulate. While retail investors were focused on FOMC headlines, BNP Paribas raised its 12-month silver price target to $100 per ounce. Bank of America raised its target after real yields narrowed and ETF inflows strengthened. While you were watching a $7 price drop, institutions were noting that the 2025 global supply deficit reached an estimated 230 million ounces, one of the largest shortfalls in market history. And while the mainstream media covered the price going down, nobody mentioned that India became the world's largest importer of refined silver in 2025, importing approximately $9.2 billion worth, a 44% increase over 2024. India's demand is not slowing in 2026, it is accelerating. The disconnect is stark. Retail investors are reading, silver is dropping. Institutions are reading, silver is on sale during a structural shortage. Every EV built uses 67 to 79% more silver than a combustion engine. Every next-generation TOPCon solar cell uses 1.5 times more silver than the cells it is replacing. Every AI data center being built requires silver in its semiconductors and power electronics. None of those demand drivers care what the FOMC minutes say tomorrow. But here is what the big players know and most people will completely miss. The historical patterns for silver in this exact setup point to something very specific happening next. Let's go back to September 2022. Silver was trading at $17.40. The Fed was hiking rates aggressively. Inflation was running hot. The mainstream narrative said silver was dead money. What happened next is the reason this moment matters so much. Within 18 months, silver climbed from $17.40 to $32 warners, an 84% move. Then in 2025, it ran to over $45 before pulling back. Every single time, silver has faced this exact combination, Fed paralysis, dollar strength, and accelerating industrial demand running beneath the surface, it is compressed like a coiled spring. The longer the compression, the more violent the release. The 2022 parallel is not perfect, but the structure is identical. Rates frozen, retail selling, institutions quietly accumulating, supply deficits ignored, price suppressed near a key technical level. We are in that moment right now on February 17, 2026, with silver sitting at 75.98 and the FOMC minutes dropping tomorrow. Now let's talk about what has not changed, because this is where most people make the biggest mistake. They confuse a price move with a fundamental shift. First structural factor, still completely intact. The supply deficit, 6 consecutive years. The Silver Institute projects a 2026 deficit of approximately 180 to 215 million ounces. No new major silver mine has been permitted and brought online since 2019. Mine development takes 7 to 10 years minimum. The shortage is structural, not cyclical. Second factor still intact. Industrial demand from the energy transition. Solar installations globally are projected to exceed 800 gigawatts in 2026. Each gigawatt requires roughly 1 million ounces of silver. The math does not change based on what Jerome Powell says tomorrow. Third factor, still intact. China's export restrictions on refined silver, which took effect January 1st, 2026. When the world's largest refiner restricts supply to global markets, that tightness flows through to Western exchanges over the coming months. Not immediately, but inevitably. Fourth factor, still intact. Central banks in emerging markets continue to hold and accumulate precious metals as dollar alternatives. The de-dollarization trend driving gold purchases is creating a psychological and structural floor under the entire precious metals complex, and silver moves in that wake. I'm going on the record right now. Screenshot this. Silver reaches $95 per ounce by October 31st, 2026. Here is why this is not speculation. The Fed will begin cutting rates in Q3 2026. When the first cut comes, real yields will drop. The dollar index will weaken. Non-yielding assets will catch a massive bid simultaneously. Silver, which is already running a structural supply deficit and has compressed for 3 months in the $74 to $82 range, will have the release mechanism it needs. The FOMC minutes tomorrow will likely confirm the Fed is on hold but watching inflation. That removes the uncertainty, and markets hate uncertainty more than bad news. Once the uncertainty clears, positioning flows back into silver. The spring releases, $95 by October 31st, 2026, on the record. Now let's talk probabilities, because there are 3 realistic scenarios playing out from here. Scenario 1, probability 60%. Silver consolidates between $74 and $82 through March 2026 as the market digests the FOMC minutes and waits for clearer rate signals. Then it breaks sharply higher in Q2 and Q3 as rate cut expectations solidify. This is the base case and aligns with the historical 2022 pattern. Scenario 2. Probability 30%. The FOMC minutes tomorrow reveal a more hawkish tone than expected. Real yields spike. Silver drops to the $68 to $70 support zone briefly, a flush that shakes out retail holders before reversing hard. A dip to $68, followed by a run toward $100, would be consistent with the violent spring release pattern we saw in late 2023. Scenario 3. Probability 10%. A major macro shock, escalating trade war, surprise credit event, dollar liquidity crisis, temporarily suppresses all commodities, including silver, below $65. This scenario delays the recovery but does not change the structural deficit. It just means a longer compression period before the larger move. Understand what these probabilities tell you. In 90% of outcomes, silver is materially higher by end of 2026 than it is today at $76. Now, let me speak directly to each type of person watching this, because the right move depends entirely on your situation. If you are holding physical silver, bars, coins, stored metal, the message is simple. Do not let a $7 price drop in a low liquidity holiday session shake your conviction. Physical metal held outside the banking system is not subject to the same pressure that paper futures are. Your position is intact. The supply deficit is your thesis. It has not changed. If you are actively trading silver with leverage, the next 24 to 48 hours are the highest risk window. The FOMC minutes drop Wednesday. Volatility will spike. Leverage positions in both directions are dangerous until the dust settles. Wait for the reaction, read the direction, then position accordingly. Chasing price before that event clears is how retail traders get wiped out. If you're sitting on the sidelines with cash, waiting for clarity, the FOMC minutes tomorrow are your clarity event. Watch what happens to the DXY immediately after the release. If the dollar weakens on the minutes, that is your green light. If it strengthens, wait for the washout near $68 to $70 before considering entry. If you bought silver above $83 and you're currently underwater, understand this. You're sitting 8% below your entry on a metal that has a 6-year structural supply deficit, surging industrial demand, and institutional price targets above $95. The question is not whether your thesis was wrong. The question is whether your position size allows you to hold through this compression without being forced to sell. Here are the 4 specific indicators to watch right now. Watch the DXY, the US dollar index. If it breaks below 103.50 after the FOMC minutes, silver will move. Watch COMEX silver inventory levels, currently sitting near multi-decade lows. Any further drawdown accelerates the physical squeeze. Watch the silver ETF flows, specifically SLV and PSLV inflows. When Western institutional money starts flowing back into silver ETFs, price follows within days. And watch the gold to silver ratio, which currently sits above 85. Historically, when this ratio compresses below 75, silver outperforms gold violently. Every compression below 75 in the last 20 years has preceded a major silver rally. There are 3 types of people watching this video right now. The first type is panicking. They see $76 and they are already calculating their losses and questioning everything they thought they knew about silver. This person sells at the bottom and buys back near the top. This is how wealth transfers. The second type is frozen. They have the information, they understand the supply deficit, they understand the FOMC dynamic, but they cannot bring themselves to act because the price chart looks scary. This person watches the move happen without participating. The third type is learning and preparing. They watch this entire video. They understand why silver is at $76. They know the 4 indicators to watch. They have their scenario map. They are ready to move when the signal comes. Not before, not after. This person is who this channel is made for. Markets do not destroy wealth. They transfer it. From those who react emotionally to those who prepared quietly. From those who sold at $76 because a chart looked weak, to those who understood that 6 consecutive years of structural supply deficit does not reverse because of a Fed meeting transcript. Every major silver rally in history was preceded by exactly this kind of moment. A flat price, confused retail sentiment, and institutions building positions in silence. We started this video talking about a drop to $76. That number is not the story. The story is what is underneath that number. 6 years of deficit, surging industrial consumption, China restricting refined exports, and a Fed that is one pivot away from releasing the spring. That is what is actually happening while everyone else is distracted. If this video opened your eyes, like it right now and subscribe to The Hidden Economy. Send it to someone who is panicking about their silver position right now. They need to see this before they make a decision they cannot undo. And drop one phrase in the comments. I see the deficit. That tells me you understand what is actually driving this market, and it tells me what kind of content to make next. This content is for informational and educational purposes only and does not constitute financial advice.